let me introduce Kevin Lepsoe, who's obviously the founder and CEO of Infinity. Previously to this, he led Morgan Stanley's financial engineering and structuring department within fixed income, and you can obviously see with what's being built here, a lot of the foundational stuff with what you were doing in a past life. So let's kick things off with the presentation.
All right, thank you for coming here. I think the most important message I want to get across today is this idea that, at least over the last couple of years, we've all been talking about like tokenization, real world assets, institutional crypto. And invariably what this revolves around is something that we all know quite well, at least many of us from a previous world, and that's called fixed income. And so I'd like all of us to just acknowledge that like a lot of this really does revolve around fixed income, and kind of going forward, let's continue this conversation around institutional crypto being more fixed income, or institutional crypto fixed income. I entered this space in, there's the white thing. I entered this space in 2010, not professionally, started mining a bit of Bitcoin on my computer with a buddy. We don't know where that computer is, but that was kind of my first foray. I think many of us have kind of like a similar experience, but I spent 12 years in finance. I then moved into tech, and then in tech, one of my early investors here in Hong Kong, they were some of the critical infrastructure guys in the crypto scene. They invested in me back in 2014. Back then, I wanted to think of Bitcoin as a currency, and if it is a currency, let's just treat it like yen or euro, whatever it might be. And in that case, can we create interest on it? Can we do cross-currency swaps? Can we do options? So on and so forth, right? But that's 2014. You don't have a lot of this infrastructure that's now in place. And so what I want to show you now is that we actually do have a lot of this infrastructure coming in place. And so as we do that, let me first talk about really the kind of like, actually I'll get to that in a second. I want to talk about the players in the financial system. But before I do, just quickly, my team, most of us are ex kind of TradFi guys. We have 23 folks in the company now. About 2/3 are engineers. Half of those engineers are TradFi, quants engineers. Half of them are regular, tech Web 2 engineers. And the rest of us are just a mixed bag of folks from the product side, as well as, actually that last third, half of us are engineers as well. But so yeah, very engineering heavy, but very quanty, mathematical in terms of background. Our investors are amazing. A number of them are here today. And so if you see anyone from these companies, thank them and for helping us make this happen. Where am I here? Yeah, basically just want to talk about the players in the financial system. And so anyone know what this is? Well, this is the players in a financial system. One of the largest systems, and this is the shadow banking sector. It's basically a map that the Federal Reserve created following GFC in 2008. I think it's a 2009 or 2012 update. The purpose at the time was basically to understand the market for credit and credit intermediation. And of course, the backdrop behind the financial crisis was largely credit related. And so if you're going to regulate that market, you need to understand it. These are the players in that market for credit. What we're ultimately seeing is that on the far left side, you have your borrower, and on your far right side, you have your lender. So when you go to the bank and you borrow money, you're going to pay 5%. Someone over there on the far side is going to earn 1%. 4% is all just disappearing into this ether called the shadow banking community, finance, financial sector. This is ostensibly what we're all here for, right? The goal of crypto in some shape or form is to challenge the rails that are currently in place within the traditional financial system. This is what it is. And not many people understand how this works. That happened to be my group at Morgan Stanley. We basically created products that would help the different participants kind of hedge or understand or transfer and convert the risk from one part to the other. But it's a complex beast. Nonetheless, in finance, like many of us would probably remember, is that you always potentially think about the day that you'll be made obsolete by like a spreadsheet, right? And so, that's really the goal, right? So can we replace that and those 12 intermediaries with a spreadsheet and, Yes, we can. In crypto, we don't talk about spreadsheets, of course. We talk about lines of code. But it is absolutely possible, and we're very close to it. So those are the players within the financial system. That's why we're building, what we're building. Just going back here. I guess the two goals, the two reasons I want to highlight this. So really one is that this is the end goal. We want to kind of strip out, make that part more efficient. The second thing is that we talk about money a lot in crypto, money and stable coins. And yet there's an intimate relationship between money and credit, right? There's $5 trillion of M0 money in the US, but there's $71 trillion of credit. And so credit is a much larger beast. It can look and behave like money, but it's not. It's far more complex. And so we need to understand this if we're going to be able to understand money within the future of finance. So yeah, so that was the players. This is the structure of the financial markets. And this is what we call the non-arbitrage kind of structure of the financial markets. It's largely driven by math and I guess economic theory, like what incentivizes people to act in the certain ways that they do. In most cases, it's free money or arbitrage, right? And that really drives the interconnectedness, the relationships between everything that all of us do within a financial market. And so, yeah, on the top side of it here, you have basically like equities or FX. We might call these like single factor markets. And on the bottom side, you have fixed income, a bit more like multi-factor. We can discuss that later. But this is crypto today. You have basically some definition of money, whether that's stable coins as they are today or CDBCs. You have spot, and you have all this other stuff. I don't know if you can see where it's highlighted, but these first 4 or 5 are what are called cash markets, whereas further down, those are derivative markets, right? So you could have $100 here in a position, but you could have $1,000 kind of replicating that position. Nonetheless, these two are highlighted. In crypto, we obviously trade futures and options. There's a whole bunch of that stuff that goes on, right? But this is a map about non-arbitrage trading, and it's, again, what drives and ties the markets together. We don't have interest rates yet properly in crypto. And if we want to get futures to be done properly and fully hedgeable, we need to get interest rates done to like an institutional or a high quality level. Most importantly on this page, this is the financial markets, and everything relies on getting this done right? So to the extent that we can do this, the rest of everything will kind of fall into place. And oh, that's this slide here. Okay, convergence of financial markets. I posit that we really only need 2 things to make this happen. The first thing is the markets today logically separated, right? You have your traditional financial markets, you have your crypto markets, and they move kind of independently. The Fed might raise interest rates, or they might raise them again, and Bitcoin, might rally. But logically, there's no formula or no mechanism that naturally makes you want to kind of trade one versus the other. And so that's kind of where we are today. Tokenization. We had this kind of flurry of tokenization 5, 6 years ago. I'm talking about this in the equity sense to start. So you might tokenize like Tesla stock, and it's fractionalized now. More people can trade it, but it doesn't really do much. A lot of the discussion around tokenization and headlines are really about banks doing it internally, right? So you take like a JP Morgan, we've done like a $1 billion, $1 trillion, whatever of tokenization. None of that is going to be seen in our world, in the crypto world. It's going to be seen on these private networks internally. And it's going to be seen, it's the same thing as them saying like, we're using like this type of database and we're going to shift to another type of database. That's really all that's happening. But functionally, they might have a series of processes and they're just going to make 1 or 2 faster. So we need to understand tokenization in the way the TradFi guys talk about it and the way kind of the crypto guys talk about it. What's far more important than this concept of tokenization is the tokenization of bonds. Now, this part is critical. Again, they trade as completely separate worlds. Now, when we can tokenize treasuries, and we already have tokenized like money market funds. I don't know if Eugene, Open Eden guys are here, but here we go, right? But tokenized money market funds, and we can bring them on chain. Now we are fundamentally trading an instrument within the TradFi world head-to-head against a stablecoin in this world, right? So the moment you bring those two assets together, how can we force these assets together to create some type of arbitrage to now bind the two ecosystems together? And so the tokenization of not just money market funds, but in the future treasuries, a 1, 2, 3, 5-year treasury, that will be critical to bring these markets together. So that's number one. Now, fundamentally, how do we bring it together, right? If I have in this example, I have a 5-year treasury paying 5%. We could tokenize that treasury. We could bring it on-chain into the world of stablecoins. And I could borrow stablecoins at 3.5%. And a logical person would buy treasuries, borrow at 3.5%, spot it back into, off-ramp it back into dollars, buy more treasuries, back and forth, back and forth, back and forth. Basically closing this arbitrage, right? And what that does is it creates a logical binding between these two universes, right? So that creates a yield curve. That creates a backbone for the synthetic dollar. Whether the future is, USDT, USDC, CDBCs, or something else, now this entire digital world is, it has this kind of backbone to be complete. And in some sense, at this point, you don't need to, okay, I care about ETH and Bitcoin, but you kind of don't need to care about them at this point, because now we have the rails for the rest of that TradFi financial system. We can have credit markets, we can have interest rate swaps, cross-currency swaps, credit, a whole bunch of other things, because we've now bound their curves together. So this is the second part, basically, to bring those two worlds together. So there you go. Yeah, basically tokenizing treasuries, bring them on-chain, and now you have one component of that ecosystem trading here, and then boom, the rest of the ecosystem is there. All right, but you can't do this without technology and a platform to do it, and that's us. So we're launching our rates trading and financing exchange, and I'll show you now quickly how it works. Okay, well, there you go. I'll sit back here. So in the DeFi world, I guess you're familiar with like Aave and Compound and things like that. This is the simplest experience we can offer here. But it's basically just lending or borrowing on a floating rate or a fixed rate. And you don't need to worry about like limit orders or market orders. It's just like you lend and borrow. Maybe there's a little bit of slippage, and like that's it. This is the most kind of basic experience, and we can do it for ETH and a handful of other tokens. We're really just going to start with blue chip tokens today. For the more sophisticated trader, we have a full kind of experience, and so this is unlike anything that's out there. I mean, it's exactly like a CeFi experience, but it's non-custodial. And so you come up to us with your MetaMask and you trade through your MetaMask. This is kind of like the real deal. We have kind of market orders, limit orders, full order book, trading view, positions, duration, yada yada. If you're a developer, we have a full set of API docs you can integrate with. Over here, just what are your positions? I want to highlight that here. If you are holding on to deposit tokens like Aave tokens, A tokens, Compound C tokens, we could potentially risk manage even like Uniswap LP tokens or Curve LP tokens. We can take your liquid staking tokens at the bottom, but most importantly, again, these tokenized real-world assets. And so, you can walk up to us with tokenized money market funds with Open Eden, for example, or a Matrix Port doc, have their STBT. In some short period of time, you can come up to us with a property, and we'll provide financing. So that's where we are, like, very soon. And finally, this is just your risk. So you can break your risk down into FX sensitivities, interest rate, kind of curve movements, et cetera, et cetera. If this stuff matters to you, we can talk about it in more depth. But there we go. So just a couple more slides here. That's it. We'll have two venues. One is permissionless, and the other will be permissioned within a full KYC AML perimeter, basically opening this up to everyone. From a use case perspective, it's unlimited, right? I mean, this is TradFi interest rates, but it's within the digital asset sphere. So anything that we've wanted to do within that TradFi world, we can now do in this space. And so there's obviously your net lenders, treasuries, yield farmers. There's kind of net borrowers. You have guys who are like, professional miners, right? You might borrow in dollars and you might earn like Bitcoin yield, and you have that kind of cross-currency risk. You can swap that back into dollars now, right? You might be a professional ETH validator, right? Again, borrowing in dollars and validating in ETH, swap that back into dollars, boom, done, right? On the flip side, I might be a Bitcoin like hodler from the early days, and I'm investing in the dollars world, and I want to swap my dollar returns back into crypto. Easy peasy. So complete set of use cases, but on the trading side, we'll be looking to integrate shortly or soon, hopefully with kind of a Talos and like Falcon X, with exchanges helping to offer kind of that back-end liquidity. A handful of banks as well looking to build their prime businesses. It's a very capital intensive for banks, and so from that perspective, they could have a capital-light business basically backing out liquidity through us. But similarly, of course, Fireblocks, Zodia, and a handful of others, Hex Trust downstairs as well. Looking to work with these guys to figure out this. That's it. I kind of talked about it. Basically, we can provide financing on basically anything. Just speak to us about it, and then that's it. Various market-making incentives. Custody, we'll be looking at off-exchange settlement on the permissioned entity. We will eventually have a token for whitelisting, and there we have it. So, thank you for this. Again, if there's one or two words that you remember here, it's just fixed income, right? And we need to start kicking this off in crypto. A lot of the discussions have been around more like FX or equity-like related business, but if we want to go down this institutional path, we need to start figuring out fixed income. So thank you.